All right, let's dive into a really fascinating analyst report that puts one company, ExxonMobil, right at the heart of a major global crisis. The analysis makes this compelling case for the energy giant as a kind of safe harbor in a storm. But is it really? Well, we're going to break it all down and see what's what. Okay, picture this. The year is 2026, and the global markets are just teetering on a knife's edge. And why? Because a critical artery in the world's energy supply has just been completely choked off, sending these massive shockwaves through the entire financial system. And boom, this is the immediate result. As of March 30th, the price of Brent crude oil just skyrockets, blowing past $115 a barrel. Now, that's not just a number on a screen, you know? It's like a flashing red light for the global economy, signaling a huge supply shock. So all of this chaos brings us to the central question of the report we're digging into today. When a market is absolutely gripped by fear, where does the money go? Where does capital flow for safety and maybe even for profit? Well, this analysis argues it's flowing decisively towards one specific place.
The whole crisis really ignites right here, in the Strait of Hormuz. You've got to think of this place like a vital artery for the entire global economy. We're talking about nearly 20% of all the world's seaborne oil passing right through it. But now, Iran has essentially created a blockade, causing a really dangerous bottleneck in the energy supply chain.
And just look at how fast everything has escalated. On March 29th, you have the G7 condemnation. Just one day later, Iran puts this disruptive toll gate system in place. And now, the U.S. has an April 6th deadline for some kind of diplomatic solution, while the Pentagon is already thinking about sending in more troops. You can just feel the tension ratcheting up. This tension creates something the markets call the Hormuz premium. It's basically a risk tax that gets added to every single barrel of oil. The bigger the risk, the higher the premium. And here's the kicker. This premium is a direct windfall for energy producers that are located safely outside the conflict zone. So who is in the best position to capitalize on all this? Well, according to this analysis, the single biggest beneficiary of this crisis and that Hormuz premium is ExxonMobil. So why ExxonMobil? I mean, what gives it this unique strategic edge? The report argues it's this perfect storm of geography, amazing performance, and some really smart financial engineering that basically insulates it from all the chaos. Just look at this performance gap. It's pretty wild. While all this geopolitical turmoil is dragging the broader S&P 500 index down by 4%, Exxon stock has surged an incredible 39%. And the report says, hey, this isn't just some lucky break. It's the payoff from a very deliberate, long-term strategy. So the real secret sauce here? It's all about where their assets are. The company has been systematically shifting its focus to politically stable, low-cost areas. In the U.S., they bought Pioneer, which doubled their acreage in the Permian Basin. And then there's Guyana, which they call the crown jewel. It has over 11 billion barrels. The end game is for these safe haven assets to pump out 65% of their total production by 2030. And this quote from the analysis, it just nails it. ExxonMobil's irreplaceable asset value shines brightest when energy security becomes a national priority. In other words, when the world gets nervous, their safe assets become incredibly valuable. But it's not just about the assets they have in the ground. The report makes the case that Exxon has also built a financial fortress. It's about having the raw financial firepower to keep investors happy and to weather pretty much any storm. Get a load of this number, $37.2 billion. Just let that sink in for a second. That's how much cash ExxonMobil handed back to its shareholders in 2025 alone. The report really hammers this home. This isn't just a side effect of high profits, it's a core piece of their strategy. And here's how that massive number breaks down. $20 billion in share buybacks, which just reduces the number of shares out there and helps boost the stock price, and over $17 billion in dividends. And get this, the company has raised its dividend for 43 straight years, which, as the report points out, creates this amazing safety net for investors. But here's where the story gets really interesting. The report argues this is about so much more than just today's oil prices. It paints this picture of a company going through a deep transformation, evolving from a traditional oil company into what it calls a high-tech energy giant. So how are they doing it? Well, it all comes down to three big moves. It's all about using their deep expertise in chemistry and engineering, what the report calls molecule management, to build totally new businesses that are built to last. First up, carbon capture. Now, Exxon isn't just using this tech for themselves. They're actually selling it as a service. They're signing these huge deals with industrial giants like Lind and Nucor, and they're basically getting paid to help them decarbonize. It's a whole new way to make money.
Second is lithium. By using this modern technique called direct lithium extraction down in Arkansas, Exxon is planning to become a major supplier for EV batteries by 2027. This is them making a direct play to get into the supply chain for the whole green energy transition.
And third, high-value products. We're talking about things like advanced polymers for medical devices or lightweight plastics that make cars more fuel efficient. The game plan here is to grow sales in this division by 80% by 2030, building a business that's way more insulated from the crazy swings of crude oil prices. Okay, so you put all of this together, how does the report suggest an investor should actually play this? I mean, what's the actionable strategy here? Well, the report lays out a very specific game plan. It sets a long-term price target of $196, but warns against chasing the stock. Instead, it suggests a buy zone somewhere between $152 and $158. It advises investors to wait for a natural dip, what traders call a pullback, maybe down to its 20-day moving average, which is a key short-term trend line. And the strategy includes clear exit points, both for taking profits and for cutting losses. Of course, no investment comes without risk, right? The analysis is very clear about the potential downsides. A sudden peace deal in the Middle East would almost certainly crater oil prices and Exxon stock along with it. Also, ironically, super high oil prices can actually squeeze profits in the refining business. And, of course, the long-term pressures from regulation and ESG investors are always a factor. But even with those risks, the report's final verdict is pretty powerful. The big takeaway isn't that Exxon is just some old-school fossil fuel dinosaur ignoring the future. It's that it has already evolved. The analysis frames it as a transformed, high-tech energy company that is perfectly positioned for this new global reality. And so that leaves us with this question. After everything we've looked at, is ExxonMobil a true safe harbor that's built on smart assets and financial discipline? Or is it really just a high-stakes bet that instability and crisis are here to stay? According to this report, the answer to that question defines one of the most compelling investment stories of 2026.